Ticker symbol DEC has returned over 107% in the past year, and this has been fueled by an impressive 47% year-over-year net income growth. Today, we'll be analyzing a high-quality stock which has solid fundamentals, high efficiency ratios, and which is in a highly demanded and profitable sector. So we'll be looking at Deckers Outdoor Corp, a shoe company. In their annual report, they describe themselves as a leader in designing, marketing, and distributing innovative footwear, apparel, and accessories for casual lifestyle and high-performance use. So basically, they sell their products through either retailers, distributors, or directly through their direct-to-consumer business, where they use either the physical channel through their own retail stores or the digital channel through e-commerce websites. It's important to consider that all their products are manufactured by independent manufacturers with whom they have long-term contracts. They divide their operations into 3 different segments, the first one being UGG Wholesale, which is their biggest brand through both physical, through Macy's or Nordstrom type of retail stores, and online channels through, for example, Amazon, Zappos, or Zalando. And then second-wise, they have their other brand Wholesale, where they have a very successful assortment of different brands, such as Hoka, which we're seeing in the picture right now, Teva, or Sanuk. And finally, they have their direct-to-consumer business, which they can either do through the e-commerce business, through their own websites and their own platforms, or through their own retail stores. And to be a shoe company, Deckers has incredible financials with an astonishing return on capital employed of 25%, way above its industry average, an interest coverage ratio of 190 times, meaning that it won't have to worry about debt anytime soon, and a very solid cash conversion of 82%. This ratio, we generally want to look and have it over 80%, so Deckers is actually meeting with the expectations. And what it means is how good a company is at converting their net income into free cash flow. Then they have a very solid profit margin of 49% and an operating margin of 18%, which is very solid. Deckers' growth over the past 2 to 3 years has been extremely impressive, with their revenue, gross profit, and net income growing quarter after quarter, and recently their net income being up 47% year over year, with their net margin rising by 28% year over year as well. And Deckers has funneled this growth through leveraging themselves in order to grow faster. However, they have done so responsibly, as we can see that their current ratio is right now sitting at around 3 times, which is very solid, and their debt to equity at 0.13 times. Both very safe metrics and showing that this company is in a very good debt position. In terms of efficiency ratios, of course, since in the last quarter their net incomes actually skyrocketed, while their efficiency ratios have boomed in this past quarter as well, with the return on invested capital, which has generally been sitting at above 40%, which is extremely solid, right now rising all the way up to 75%, something incredible, especially for a shoe company. And when looking at their fundamental analysis, this company almost gets the perfect scorecard, scoring 7 out of 8 ticks, as they have low liability risk, they have an extremely solid balance sheet as they can pay all their short-term debts with their current assets. They, of course, conduct share buybacks, which is extremely good for the investor. And this company has pricing power. Why? Well, through their existing moat, which we will be talking about in just 1 second. But first, this company has been able to grow their free cash flow organically. And the way they have been doing this is by growing their revenue organically. Now, Deckers has a very wide existing moat and a competitive advantage as they're one of the largest players in their industry. They have some of the most recognizable brands, especially geared towards the US and towards a very broad market, where just by the name of their shoes, for example, Uggs or Hoka, you already know what expectations you have for your shoe. There is a lot of people that will buy Uggs just because they're Uggs without even trying them on or without even trying to consider other alternatives. And this is one of the strongest competitive advantages a company can have. And in terms of long-term analysis, I believe that Deckers does have it still in them, with the possibility of expanding geographically, as Deckers is mainly still in the US. Some of their brands like Uggs have expanded into other developed economies. However, they still have a lot to do in terms of geographical expansion. And then the second growth avenue that they have as a possibility would be to develop new offerings, whether this can be new shoes, other types of apparel, or just partnering with another company to create a combined shoe. But in terms of valuation, since this company has risen an insane 107% in the past year, right now we can say that they're very overvalued as they're trading at a PE ratio of 33 times, which is extremely above its average for the past 4 years, which was trading at around 22 times. Now, when considering their free cash flow yield, it does not look that undervalued. It looks expensive, but not something very ridiculous, as they're yielding a 1.93% free cash flow yield. When compared to a long-term inflation rate of 3%, it does suggest that the company is expensive, however, nothing too crazy. When looking at the risk and possible challenges, the main risk that I see here is the worsening competitive landscape, as the shoe industry is extremely competitive since it's extremely profitable. And you have some of the biggest players inside this area, so companies such as Adidas, companies such as Nike, Puma, Crocs, even for the more casual shoe wear. So this is, of course, a very competitive landscape where you have to be on top of the game. Deckers has to be constantly renewing their designs, being able to provide their customers with what they deserve at reasonable prices, and their quality has to be top-notch all the time. Now, I don't see any possible upcoming regulatory changes to the shoe industry, and I don't see Deckers not meeting performance objectives since they have been meeting them for a very long time. And as we can see, last year they increased their net income by 57% in 1 year. The other risk I do see is the market. The risk of an economic downturn or the risk of this just being very cyclical is still lurking there when analyzing Deckers. Why? Well, because people, whenever there is an economic downturn, they will cut back on spending, and one of the things they can cut back on is buying new clothes. They will probably recycle or just keep the clothes that they have for a couple more years or a couple more months and delay their purchases, which will directly affect the revenues of companies such as Nike, Adidas, or especially Deckers. Now, before moving on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence before actually purchasing the stock. However, I do believe that this is a company that has a very strong competitive advantage, which provides consistent, predictable, and of course growing cash flows, and which has high return on capital employed, meaning that the management is able to create value for the investor. So I believe that this is a very good company and that it will probably be a great investment. However, right now it trades at a very hefty premium since it returned 107% past year. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.